Well, hello Dragons, and welcome to this instructional video for Lesson 13, Part 1, Saving. The main idea behind this economics lesson is saving is the non-consumption of disposable income. With that in mind, by the end of watching this video, you will be able to identify the benefits gained by saving money, explain how savings accounts differ from time deposits, and describe how economists measure savings. Now that the outcomes for this lesson have been shared with you, let's get started. In a free enterprise economy, business owners can choose how to organize their companies, and workers can make choices about how to use their labor. Similarly, consumers have an important choice to make: how to use the income at their disposal. They may spend this income or save it, consume it or not consume it. Spending is the consumption of disposable income, money available after taxes have been paid. Saving is the non-consumption of disposable income. Spending and saving are equally important to a strong economy. Spending reflects demand, how much of a product consumers will buy at a particular price. As spending increases, producers expand supply, and as spending decreases, producers reduce supply. But how is saving important? Think about what people can do with money they have saved. In general, people save for 5 main reasons: for major purchases, such as a car, house, or refrigerator; to pay large annual or semi-annual bills such as property taxes or automobile insurance; for unexpected expenses such as medical treatment or home repairs; for major long-term expenses such as college tuition or retirement needs; and to amass wealth or leave an inheritance to their children. No matter what reason people have for saving money, they experience 2 benefits: security and interest. Saving money in a bank or other lending institution provides 2 types of security. First, money in a bank account cannot be lost because of misfortunes in the home, such as fire or theft. Second, most financial institutions are protected by state and federal deposit insurance. These insurance plans protect savers from losing their money if the institution closes. When you deposit money in a financial institution, you may receive a payment called interest. The financial institution pays interest in exchange for the use of your money while it is deposited. Interest rates on savings vary according to the type of account chosen and the financial institution in which the money is deposited. Interest rates also fluctuate or change to reflect the general availability of money in the economy. When the supply of money in the economy is reduced, interest rates generally increase. When more money is available, on the other hand, interest rates are lower. Financial institutions, such as banks, also charge interest on the loans they make to individuals and businesses. Again, this interest is a payment for the use of the loaned money. Basically, a bank or other financial institution makes a profit in part by charging more interest on loans than it pays on savings deposits. Suppose that Monique decides to open a savings account. She already knows that savings accounts offer very little risk. While her money is deposited in a financial institution such as a bank, her funds, up to $250,000, are insured by the federal government. When Monique arrives at her local bank, she discovers that she can choose from among different types of accounts, including regular savings accounts and money market deposit accounts. Regular savings accounts, which are among the most common types of accounts, usually require only a small deposit. Many financial institutions, however, charge a fee if the balance, or the amount of money in an account, drops below a specified level. Some depositors open regular savings accounts because they offer liquidity. Liquidity means that assets, such as an account, can be converted into cash with little or no loss in interest payments. Monique could withdraw her savings from this type of account at any time. In exchange for high liquidity, the interest rate on a regular savings account is relatively low compared to the interest paid on other types of savings accounts. Monique may decide to open a money market deposit account. Like regular savings accounts, money market deposit accounts pay interest and allow relatively easy access to savings. These accounts offer variable interest rates that are generally higher than those of regular savings accounts. To determine interest rates for money market deposit accounts, financial institutions invest funds from these accounts in interest-bearing securities such as treasury bills. The financial institution passes on part of the interest to account holders and keeps the rest as profit. Because these interest rates fluctuate, however, account holders may not always receive higher interest rates. Money market deposit accounts have a fair amount of liquidity. Account holders can make withdrawals without penalty, but they are usually restricted to making a certain number of withdrawals each month. Some financial institutions place other restrictions on the money market accounts as well, such as requiring advance notice of withdrawals. Suppose that Monique decides that savings accounts do not offer enough interest. She may open an account known as a time deposit. Time deposits require the saver to leave money in the account for a specific amount of time. Savers who want to open time deposits probably will buy certificates of deposits or savings bonds. Monique may decide to deposit her money for a particular length of time. If she does, she will receive a certificate of deposit, or CD, that represents her funds. The length of time that money must be deposited is called the maturity. The maturities of CDs range from less than a month to several years. CDs with longer maturities generally offer higher interest because the higher rates compensate for reduced liquidity. Because people who invest in CDs lose the use of their money for a longer period of time, they receive a higher interest rate. In return, someone who withdraws funds before the maturity date must pay a penalty. CDs usually require a minimum deposit, which may range from $250,000 to $100,000. Both the maturity and the interest rate are established when the account is opened, and the interest rate stays constant until the maturity date. Fixed interest rates offer both benefits and drawbacks. If interest rates in general go down after Monique buys a CD, she will still receive the higher agreed-upon rate. On the other hand, interest rates may go up, but Monique will receive only the CD's relatively lower established interest rate. Monique may decide to limit her risk by purchasing savings bonds, which are issued by the federal government to pay for federal programs. The purchasers assume little risk because the savings bonds are guaranteed by U.S. government funds. Savers like Monique purchase the bonds for less than face value and redeem them at their face value upon maturity. Savers can purchase a $50 Series EE government savings bond for $25 and redeem it later for $50. If a bondholder chooses to keep the savings bond beyond its maturity date, the bond continues to earn interest until redeemed. Like corporate bonds, government bonds are a kind of loan. By selling bonds, the government gains money for programs. Similarly, consumers know that they will receive interest while they hold the bond. The increased value of a bond reflects the money borrowed from, plus the interest paid to, the bond buyer. Someone redeeming a $50 bond, for example, gets back the initial $25 plus $25 in interest. Economists measure savings to help determine the health of the economy. The main factor they consider for this process is the savings rate. The savings rate is the percentage of people's disposable income, money available after taxes are paid, that is not spent. One of the most important determinants of the personal savings rate in the United States is income. High-income households tend to save more money than low-income households. As a result, the average rate of personal savings for the nation is likely to be high when wages are high. In contrast, the average rate of personal savings is usually lower when wages are lower, for example, during economic slowdowns in periods of high unemployment. So that's the way it is with Lesson 13, Part 1, Saving. At this point, you should know that security and interest are the benefits gained by saving money. Savings accounts offer liquidity, while time deposits must remain in an account for a specified period of time, and economists measure savings by computing the percentage of disposable income that is not consumed. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons. See ya!